Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's midday Thursday, January 15th, and the title of this week's extremely important audio blog is The Swiss National Bank Starts and Ends the Gold Bear Market. Now, as I started writing this week's audio blog, it was still yesterday afternoon. I'll stop after that portion and pick up with this morning's events, which is probably wise given what those events were and the historically momentous situation that we're talking about. In fact, it's pretty ironic that the title of yesterday's article was an historically momentous day, given the incredible amount of of precious metal bullish and everything else bearish events that occurred yesterday alone, which I'm going to talk about in a second. In fact, when I started to write this article, I had only planned to write about the previous night's seemingly unprovoked collapse of copper prices in the Asian markets, ending the day at $2.56 per pound, or 5% lower than the previous night's close, and 11% below its year-end level of $2.90. Ditto for zinc, which is now down 7% this year, and lead 9%. I had been long wondering why copper and zinc had been so resistant to the catastrophic plunge of essentially all commodities, particularly Dr. Copper, which tends to be viewed as one of the most purely industrial of all commodities, and in fact had considered writing a piece on this very topic for the past week. To wit, the Bloomberg Commodity Index hit a fresh 12-year low yesterday, so the fact that copper and zinc are still 2 to 3 times above their 2003 levels, and for that matter, crude oil, which is 50% above its 2003 level, depicts not only how weak other commodity prices have been, but how potentially overvalued copper, zinc, and yes, crude oil may be. Anyhow, irrespective of whether they were holding up so well due to natural or manipulative factors, it was difficult to believe a global economic depression and accompanying commodity implosion could possibly exclude commonplace base metals like copper and zinc, especially when other construction-heavy commodities have already collapsed, such as, for instance, iron ore, down 45% in 2014 alone, compared to just a 15% decline for copper and 5% increase for zinc. And thus, last night's or the prior night's momentous base metal plunge shouldn't surprise anyone, and more importantly, serves to resoundingly validate the collapse in iron ore, crude oil, and countless other commodities, including, for that matter, numerous agricultural items as, irrespective of their need versus want status, have been oversupplied by an overliquefied banking system and systemic Wall Street fraud, greed, and financial engineering. In other words, the great deformation described by the great David Stockman, as highlighted in my must-read article to start 2015, The Direst Prediction of All. In layman's terms, so much overcapacity has been created by corporate and Wall Street greed, utilizing the historic liquidity provided by 15 years of unfettered money printing, has left the vast majority of the world's industrial complex heavily oversupplied. No market symbolizes such economic suicide better than China's communist encouraged build until you drop policy, but the same can be seen nearly everywhere, such as the doomed U.S. shale oil industry. Of course, the horribly ominous base metal crash was just one of 7 momentous topics I addressed yesterday morning, such as the accompanying crashes in interest rates, currencies, retail sales, and oh yeah, Bitcoin. Not to mention an historic surge in home refinancing applications, as homelessly as that's quite the Freudian slip, as hopelessly impoverished Americans, abetted by the closet QE the government has initiated via its off-balance sheet home finance arms, are going deeper and deeper into debt just to pay off the bills. Regarding the former, the U.S. 10-year Treasury yield decidedly sliced through the October 15th flash crash low of 1.8% yesterday morning, briefly touching 1.78% before closing at 1.85%. Back in October, I warned that invariably such spike lows are revisited, and here we are 3 months later with the Fed patiently considering mythical rate hikes in the coming months, and voila, the 10-year yield is approaching its all-time low, accompanied by similar plunges in nearly all Western sovereign yields. As I've practically shouted from the rooftop since writing the most damning proof yet of QE failure 8 months ago, The entire world is front-running QE to infinity, knowing full well that major central banks like the Fed, ECB, BOE, SNB, and BOJ have no choice but to maintain zero interest rates to infinity and monetize every last toxic corporate mortgage and treasury bond or suffer instantaneous financial collapse. Just look at yesterday morning's survey of UK investors, which now expect the Bank of England's first, also mythical, rate hike in the fourth quarter of 2015, compared to previous expectations of the third quarter of 2015, mirroring last month's FOMC survey depicting how in just 1 month the Fed governor's expectations for year-end 2016 interest rates plunged from 2.9% to 2.5%. Not to mention the Reserve Bank of India lowering interest rates this morning to try and revive the collapsing Indian economy. In other words, it couldn't be more transparent where central bankers really believe interest rates are headed. In a nutshell, this is how all fiat Ponzi schemes end. But this time around, the disease is not localized like 1920s Germany or 1990s Zimbabwe, but instead is systemic, intertwined, and irreversible. To that end, it shouldn't surprise anyone that coincidentally, just a week before a potentially historic ECB meeting, the EU courts declared Draghi's QE proposal constitutional. Regarding currencies, the EU experiment is imploding as the world's most widely circulated currency, yes, more than the dollar, plunged to a new 9-year low yesterday. Remember, I'm talking about yesterday now, at 1.174, in preparation for challenging the parity level last seen at the time it was launched 15 years ago. With just 11 days until Greece's potentially historic snap elections, in which the anti-austerity Syriza party is expected to achieve a convincing victory, it's difficult to believe fears of not only a Grexit but a cataclysmic PIGS crisis is not staring Europe in the face. As let's not kid ourselves, anti-austerity is just a euphemism for pro-default and anti-euro. Of course, the euro's plunge is also dragging the Swiss franc into hell, talk about prescient commentary from yesterday, sadly as a willing suicide partner, as not only did the SNB utilize every market manipulation and propaganda tactic imaginable to prevent the Save Our Swiss Gold referendum from passing, but instituted a negative interest rate policy just 3 weeks later. Consequently, both euro and Swiss franc price gold bottomed the very day before the vote, which was coincidentally the ultra-thinly traded post-Thanksgiving half-day holiday. And since then, prices have rocketed higher in both currencies, to the point that euro and Swiss franc price gold are just 25% below their respective all-time highs, and the euro-Swiss franc peg sitting perilously at exactly 1.2. Of course, I haven't even noted the collapse of essentially all commodity currencies as signified by the ruble, but demonstrated essentially across the board. Cumulatively, the relentless deflation caused by a relentless expanding global recession and the aforementioned massive industrial overcapacity is largely offset by equally massive import inflation, which for nations that import large amounts of goods, like Japan, equates to economic death. The combined effect of such pervasive inflationary and deflationary trends destroys earnings, balance sheets, and governments alike, fostering social unrest, draconian policies, and oftentimes war. Conversely, the, quote, strong dollar caused not by a strong economy, but a global economic flight to liquidity, which, by the way, I predicted in my year-end 2013 predictions, is utterly destroying U.S. corporate earnings. Heck, even government-supported J.P. Morgan and Bank of America badly missed earnings the past 2 days, and trust me, they will be hell to pay. In other words, the surging dollar will undoubtedly cause the corporate lobbyists that own America to put significant pressure on the Fed to not only maintain ZIRP policy to infinity, as if the markets aren't screaming for this already, but to initiate new dollar-destroying QE programs as soon as possible. In other words, the Yellen reversal I have predicted for the past year as the final currency war explodes worldwide. To that end, recall last week's audio blog title, Tick-Tock, referring to the relentless call for QE4 that stalks Janet Yellen every minute of every day. As for said recession, I have zero doubt that this is the singularly worst point of global economic activity in our lifetimes, other than perhaps a few deer in the headlights weeks in the aftermath of 9/11 and a few more at the height of the 2008 crisis. Again, I wrote 2008 is back on October 7th, more than 3 months ago. And obviously, I don't say things I don't truly believe. In other words, such catastrophic signs were eminently visible before the oil price crash, the horrible holiday spending season, the global currency contagion, crashing sovereign bond yields, and a veritable free fall of global economic data. And clearly, this thesis is being validated, which is probably why the ECB is expected, according to no less than the ultimate insider, Goldman Sachs, to announce a, quote, massive QE program at next Thursday's meeting. To wit, yesterday's news that U.S. retail sales plunged an entire percent in December, as I predicted, in the heart of the holiday shopping season, compared to expectations of a flat result. In other words, what I've been screaming all along, that this would be the worst holiday season since the heart of the 2008 crisis, is coming to fruition. Remember, last year was the weakest holiday season since 2009, amidst the so-called recovery the Fed has been lying about. And given that Black Friday weekend sales were a whopping 11% lower this year, it's all but a fait accompli that even the government's top book hookers will shortly be admitting to the reality of recession. As we speak, S&P 500 earnings are expected to actually decline in the coming 12 months, and this with very few companies having already reported. In other words, earnings expectations will likely plunge in the coming weeks from already negative levels, no doubt aided by the aforementioned dollar surge, which just in the past few weeks has accelerated with a vengeance. And I even mentioned the record plunge in rig counts, as don't forget, an incredible 1/3 of all S&P 500 capital expenditures are energy related. I mean, we are speaking about carnage on a global basis, just like 2008, but with massively higher debts, deficits, volatility, geopolitical tension, and essentially zero central bank dry powder. Heck, even gambling revenues are plunging, with Atlantic City and Vegas casinos starting to go bankrupt, like the storied Caesars franchise today. In Macau, China, 2014 was by far its worst year ever of gambling revenues. And here in the States, the 99% have become so impoverished and devoid of even hope that lottery ticket sales are down a whopping 20% from a year ago. Remember, one of my 2015 predictions, as elucidated in an audio blog last month, was retail Armageddon. And today's news that the nation's largest electronics retailer, Best Buy, expects negative sales growth in the coming months puts the cherry on the cake. And oh yeah, it was also reported yesterday that American Airlines load factor plunged in December. In other words, dramatically lower fuel costs have not only not acted as a tax cut for Americans, but caused them to retrench spending further. In other words, America's economy is going through the floor as we speak, and anyone betting otherwise is going to have their head handed to them. Before I close down for the day, meaning Wednesday afternoon, Wednesday's markets, that's yesterday, only validated just how desperate the powers that be are from losing total control. In yesterday's Death of Manipulation article, I wrote of how US-led efforts to control perception are failing everywhere as the unstoppable tsunami of reality rolls over their best efforts. To wit, the only markets they haven't lost yet are the Dow Jones Propaganda Average and paper precious metal markets. But rest assured, their day of reckoning is coming, and that right soon. The PPT only managed to hold the Dow's losses to 187 points after again peaking at the PPT's absolute limit down level of 2.0% by creating a paper short squeeze in oil at the day's final hour, and of course erasing gold and silver's early gains at the same time. However, the carnage in base metals was a glaring view into the said reality, and thus it's difficult to believe such maniacal, transparent manipulations can last much longer under such horrendous economic and financial conditions. Okay, it's Thursday now, Thursday morning, and all I could say is wow. Recall yesterday's article was titled An Historically Momentous Day. However, today makes yesterday pale in comparison. As per the title of today's audio blog, which I just changed an hour ago, the Swiss National Bank may well have ended any last potential for lower prices in the foreseeable future, for gold and silver that is, with an announcement that, while not unexpected to people with common sense and a lack of institutional bias, was earth-shattering in its implications. However, I'll get to that in a second, as I want to give it my full attention, but need to address some other massively cataclysmic news items, all of which scream recession, money printing, soaring precious metal demand, and exploding social and geopolitical tensions. To start, I last night saw that Russia cut off Ukrainian natural gas supplies to 6 European countries. Well, I don't want to jump to conclusions. All I can say is this. The more global economic activity contracts, the longer energy prices remain low, and the more currencies like the ruble plunge, the more likely geopolitical tensions in the Ukraine will explode. The so-called Black Swan issue isn't going away, and frankly, if we awoke to full-scale Ukrainian war tomorrow, I wouldn't be the least bit surprised. Next, Japan reported an incredible 15% plunge in December machine orders as the land of the setting sun plummets from the first to the second world at a breakneck pace. Recall, one of my 2015 predictions is the first signs of Japanese hyperinflation, and at this rate of economic decline, no doubt Shinzo Abe's printing press will go parabolic. For now, I'll skip over Europe's economy, other than to say that just 10 days from now, the Greek snap election may well catalyze the end of the euro currency and economic union as we have known it. And finally, before the big Swiss news, let's just say that the U.S. economic data was utterly catastrophic. First, with jobless claims exploding higher, and subsequently, the December Philly Fed Index plunging from 25 to 6. Recall, when the October Philly Fed Index was reported to have surged to a 10-year high of 50, that's it, 50, I wrote an article titled The Lie to End All Lies to describe its fraud. And here we are just 2 months later with it on the verge of turning negative. Okay, so it's time to discuss the day's big news, or should I say, two historically momentous news items rolled into one, which is the Swiss National Bank officially abandoning the euro peg, causing the franc to explode 15% higher, the Swiss stock market to plunge nearly 15%, the euro to free fall through major support levels like a hot knife through butter, and oh yeah, gold to explode higher. For all intents and purposes, ending the so-called bear market that commenced, ironically, with history's largest manipulative episode yet, on September 6, 2011, when the Swiss first initiated the franc-euro peg. And actually, I gave some great detail of that day, which I call Operation PM Annihilation 1, in last week's audio blog titled TikTok. Okay, yes, it was just 6 months ago when Lady Macbeth, Thomas Jordan, of the Swiss National Bank, who doth protest too much against gold's value, led one of history's most aggressive propaganda and market manipulation campaigns ever to ensure the Save Our Swiss Gold referendum wouldn't pass. In doing so, he claimed gold was a hindrance to the SNB's ability to peg the franc to the euro, enabling Swiss citizens to, quote, benefit from a debauched franc. Of course, the fact that 3 years of pegging has been utterly disastrous to Swiss economic activity, national debt, and the SNB's balance sheet wasn't even mentioned, as essentially the SNB was trying in nonsensical fashion to threaten citizens that the soaring Swiss stock market would plunge if the referendum passed. Well, with the European economy free-falling and the Greek election crisis taking form since, the euro has cratered badly in December, putting further pressure on the SNB's already exploding balance sheet in trying to maintain the doomed-to-fail peg. Thus, just 3 weeks after the referendum failed, the SNB was forced to initiate negative interest rates to prevent the peg from collapsing, as clearly the pressure on Mario Draghi to destroy the euro with the aforementioned massive QE was building like steam in a teapot. In other words, a giant slap in the face to Swiss citizens, particularly as Swiss franc price gold soared. However, that was nothing compared to today, when the supposedly unexpected abandonment of the peg, which I practically screamed was coming for weeks, was announced. To start, the massively overvalued Swiss stock market plunged 15% at today's open, dispelling yet another of Jordan's main lies. And secondly, gold prices rocketed higher worldwide, although ironically not in Switzerland, care of the franc's 14% upward explosion. In other words, Swiss citizens lost on all fronts, whereas they would have been in a dramatically better position for now and posterity if the referendum had been allowed to pass, as early polls indicated it would have. That is, before Thomas Jordan and his central banking gangster pals, no doubt led by the Fed, turned the tides by manipulating markets and publishing shameless propaganda. Of course, per what I noted above regarding the death of manipulation, such efforts in the big picture have massively backfired on them, as here we are just 6 weeks later with gold soaring, the euro in free fall, and the global economy so weak, markets are literally screaming via what they're doing in the bond pits for QE to infinity. Which brings me to the second piece of cataclysmic news, which frankly is far more devastating to the powers that be than any policy action of the piddling Swiss. That is the utter free fall of the euro as I speak. And I'm talking about Russian ruble style. Down from yesterday's 9-year close of 1.174 to an incredible 1.158 as I write, en route to below parity, to parity and below, as the very existence of the 15-year-old ill-fated union comes into question. As noted above, the ramifications of such dramatic currency movements on both Europeans and Americans alike are utterly horrifying. And if the Syriza party does in fact take over Greece later this month and demand a debt write-off, as its leader Alexis Tsipras overtly asked for last week, we may well see the sum of all fears in global currency, equity, and commodity markets. And oh yeah, $2,000 gold and who knows what number silver, far sooner than most can imagine. As for today's markets, European stocks soared as the currency collapses. Other than the Swiss, of course, whose stock plunged as its currency strengthened. I mean, how much more deformed, as David Stockman would say, have markets become in the wake of a decade of unfettered money printing and market manipulation? No matter, such bullishness on government-supported stock markets hasn't helped Japan, and it certainly won't help Europe, let alone the US, whose currency is utterly exploding as the aforementioned fear factor takes hold of global investors. In the bond market, European sovereign yields remain at record lows, whilst U.S. rates are again plummeting to oblivion, with the benchmark 10-year yield down to 1.8% from 1.85% yesterday, after having soundly breached the October 15th flash crash low of 1.89% yesterday, en route to Japan-style levels close to zero. That is, before hyperinflation inevitably arrives, rendering all interest rate bets moot. U.S. stocks initially plunged, but have no fear, the PPT was waiting at the usual 10 a.m. Eastern Standard Time to goose said Dow Jones propaganda average higher. As I write, it has fallen back to being down 40 points or so, as the aforementioned paper oil short squeeze, which took prices to $45 from $45 per barrel yesterday afternoon to over $50 this morning, is rapidly dissipating, back down to 47, en route to far lower levels as the gaping canyon between global oil demand and supply trumps such manipulative trivialities. And as for gold, it's up $35 as I write, and silver roughly 25 cents. Every cartel trick imaginable has been used this past week to suppress prices, including, not surprisingly, today. However, physical demand is utterly exploding, as demonstrated by early January U.S. Mint Silver Eagle sales, again on pace to exceed last year's record level. Not to mention, the utter explosion gold has experienced in global currencies is turbocharging such demand, making it nearly impossible to hold down even manipulated paper prices. Most importantly of all, euro price gold is up a whopping 4.5% this morning to just 20% or so below its all-time high. Mark my words, the closer euro gold comes to its all-time high, not to mention yen price gold, which is just 4% from its all-time high, and rupee price gold just 19% from its high, the more rapidly global physical demand will surge. Frankly, I'm not sure what more the Miles Franklin blog needs to say to cause you to take action to protect yourself from what's coming, as not only will precious metal prices soar to unimaginable levels, but hyperinflating paper assets are destined to experience horrific real losses, as they do at the end of all Ponzi schemes. That said, If you do decide to take such action by buying or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com.